Hello, everyone, and welcome to this week's podcast. Today, that we're recording it on, is April the 17th, but our podcast is coming out on April the 18th. My name is David Clark. I'm joined here by Miles Clark, and although it was a holiday shortened week, it was not I would say, quite less eventful week. It was quite jam-packed, even what we saw this week.
Yeah, certainly. We'll start off just by saying for those of you listening on Friday, hope you're having a wonderful day off and enjoying the lack of market action on a Friday where we would typically get a whole bunch. I think last Friday we were moving back and forth. Maybe we even had like a 3% up or down day. I forget.
Mhm.
It's been doing so much action. But yeah, certainly markets not able to, have a full 5-day trading week, but still trying to pack in a lot of movement over the course of this week so far, right? In terms of the names we typically look at across the board, most of the domestic equity space down over the last rolling week. Now, a lot of that's coming from Wednesday's move. We kind of decelerated there, or kind of exhaled into the close on Wednesday, the 16th. S&P 500 off about 3.33%. Nasdaq Composite off almost 5. The Russell 2000 off about 2.5%. So small caps also struggling. No, out of the names we typically look at, no domestic equities were in the green over the course of the last 7 days. Interesting.
Which, to your point, one of the other sort of piggybacking on that, I think that even when we saw a lot of that positive action last week, you did see some stocks initially return to buy signals. But what I think is interesting is we didn't see any of the equity indices do so. They've
Right.
all maintained sell signals. And at this point, this week's action, especially Wednesday's action, brought another reversal into those for many of those equity charts. So maybe not necessarily lower tops in every case. I know, like with the S&P 500, it formed a double top, but didn't move to that buy signal. And then we saw the reversal down yesterday.
Right.
But it sort of gives us that, oh, well, we almost got there. And now we sort of get back on our cautionary side, if you will.
Yeah, I mean, this is something that I learned when I was an intern, and not to age you, but you also probably learned a little bit older or a little bit further back than I did. If you cover up the name of the chart and you look at it, do you like it or not? That's something I do even on a day-to-day basis when I'm looking at a stock and trying to decide if I want to write a comment on it or talk to a client about it. If you cover up the S&P 500 chart, which will throw up on the screen right now, it doesn't look that good, right? I mean, you're on a string of three consecutive sell signals, continuous pattern of lower tops, lower bottoms there as well, getting a rejection around that 45, 50 mark, or excuse me, 54, 50. Geez.
It's the fours and fives
Yeah, we're
everywhere.
getting mixed up. But getting a rejection around that level, reversing back down. We haven't posted a buy signal on this chart since early 2025 in January, right? And so we've seen a bunch of downside action. And again, if you cover up the chart and kind of remove some of the maybe bullish biases that I think all of us have as we're kind of looking at markets, doesn't look that great, right?
No, it doesn't. And I mean, even with sort of how we wrapped up last week, kicked off this week, there were definitely some things that at least made us raise our eyebrows initially. I mean, one of the,
You're kidding. We didn't raise our eyebrows last week after
well,
the
at that point, I think our eyebrows would have been
Yeah,
right on
they
the
were
top of
always
our head, like almost cartoonishly up here. Anyways, looking at this week, I mean, after Monday's action, we saw a pretty decent move and some stocks returning to buy signals. We actually saw the BPSPX have one of its top 20 largest increases historically. But as we talked about in the report, it's still, even when we see those type of things, it still deserves a fair flare of caution, if you will, because many times when we see these big rises and falls within the BPSPX, same with equity indexes, it's when we're in turbulent environments. I'm
right.
not saying necessarily it's always bad equity market environments. Generally speaking, it is, but turbulence is what we're looking at, you
Yeah,
know?
and let's define really quick. A lot of our, listeners, but if you're new, you might not know what the BPSPX is. So it measures the percentage of S&P 500 stocks trading on a point and figure buy signal. So buy is going to be good. So a larger amount or a larger value is going to be a good thing here. So when this value is falling, that means that we're seeing more stocks on sell signals or conversely less stocks on buy signals. And so with our most recent exhale out of the S&P 500, we had gotten down to a reading of 14%. So roughly 1 out of every 10 of those S&P 500 stocks on buy signals. That was the lowest mark since 2022. Now we did get that reversal, right? Just like
Mhm.
David just mentioned, we got that reversal up to around 34, so about a third of those S&P 500 stocks on buy signals. But point being, you do see, at least historically, a couple of different maybe rallies and then fall back down and everything like
Mhm.
that. So you can, speaking to what David was just talking about, see some chop as markets try to figure out what levels they want to defend and really where true washout is, if that makes sense.
Right. Yeah. And that's like with even some of the shorter term indicators, I think you can get that picture better of like
Right.
them returning down to either test or go lower, some like the 10 weeks. I mean, we haven't seen those reverse down, but I know like some even shorter term ones, like weekly distributions have been moving all over the place this week, just for surely the fact we're moving around in oversold territory and moving off of lows, trying to see that improvement. So there's definitely a lot of action just transpiring within those lower levels, but I think that when we take a step back, it is the reminder that we're seeing all this transpire at lower levels.
Right, exactly.
So that's where this tone of caution that I think a lot of what we'll talk about is going to be, hey, this happened. This was at least a near-term positive, but then some tone of caution following.
Right. And David and I were talking and we were talking before about what this feels like. And we won't use the poker example, but we will, on previous podcasts, you probably heard myself or any one of the analysts just say, hey, it's about stacking the odds in your favor, right? Getting as many indicators to align with your thoughts or ultimately your investment thesis as possible. And what we're seeing right now is a bounce out of oversold territory. All of that said, though, there are more and more signs that the odds are stacked against domestic equities, that we've seen a longer term shift in the strength, not only within the broad asset classes, but within domestic equities as well.
Mhm.
We've seen a shift away from the growth focused areas, from the high beta areas that are really kind of drove markets forward over the course of 2023 and 2024. We've seen a shift away from that. And again, the odds are stacked against those guys. It doesn't mean that there's not opportunities, right? It just means we need to be approaching how we actually allocate our assets with extreme caution around current levels.
Right. And how you do that is looking at stocks that still maintain positive trends above key support, maintain high attributes. I mean, it was interesting enough this week. I mean, there were a few out there that when they saw positive action, there were some stocks that it's like, oh, they've maintained buy signals since last year and
Right.
they're still looking fine. So that's really where we would say, you either hold, keep your positions, or that's where you're developing a watch list to look for opportunity.
Right. And this also offers us, excuse me, a nice opportunity to talk about this idea of positive relative strength, right? It's super easy to think about relative strength as buying the asset, the market's up 5% and you find the asset that's up 15%. Nice job, right? You get a cookie, right? You got something that was up more than 10% more than the S&P, right? But there's also an element of relative strength which your clients will probably appreciate the same, if not more, which is protecting their assets from downside action. So if the market is down 10%, can you find the asset that's only down 2%, right? That is another feather in the cap for money managers. And that's, again, point being why we use the technical attributes, because it has that element of positive relative strength, not only when the markets are going well, but when things are moving towards the downside, can we find those areas, not only stocks, but points or sectors within the market that are exhibiting positive relative strength, that is.
At this point, it's a small list,
It is a small
but
list. Yeah, no, it is. And a good place to kind of start about necessarily, we got a little bit off topic there, but going back to this idea that the odds are kind of stacked up against domestic equities, and how do we actually decipher that a little bit more? We can use the positive trend for the S&P 500, which PTSPX is going to be what it's called. It's another one of our indicators that simply just gauges or measures the percentage of S&P 500 stocks trading in a long-term positive trend. So again, looking at that long term, seeing what's strong, seeing what's weak. Now, historically speaking, we have seen or kind of drawn a line in the sand around 50%. So one out of every two stocks is trading in a positive trend. We've run a sample portfolio, which we can throw up on the screen or maybe whatever it may be. But running this idea, most of the historical market action, positive market action since 2001 comes when this value is above 50. So when there's more stocks in positive trends than they are in negative trends. We've seen over the course of this exhale, this value fall below 50, right? So now roughly 3 out of every 10 S&P 500 stocks are in a positive trend. That's a pretty low value, right? We haven't seen that since 2022. And so again, it's going back to this idea that we've seen more weakness emerge, long-term weakness, that is, and that, we're in a little bit more of a treacherous market environment.
Mm-hmm. It's interesting that we make callbacks to 2022 because I mean that was sort of the last time we would say things got turbulent. And some of those lessons, some of those things that transpired then, we can kind of at least look back to now. Not that obviously it'll happen the same, but the story still makes sense in what you're talking about in terms of what we're looking for that stacks on where we're trying to stack odds in our favor. Because in 2022, we saw commodities really benefit, take over the reins as a baton, take over that leadership baton for a while there. International did for a period as well. But even then, under the hood, within domestic equities, we saw shifts to utilities and energy and other things like that. Now, again, that's not transpired the same way today,
Right.
at least for the time being. But we've seen some of those things like commodities picking up signals and moving closer to domestic equities, along with international. More importantly, we've started to see some of those other defensive assets down near the bottom pick up. And that's really why, in a lot of ways, we'll highlight a positive and then there's a but or the asterisk right now,
Yeah, no, I mean, and you look at the, and then we'll stop talking about the indicators. But the idea is that when we get to really washed out territories for that PTSPX chart, we're certainly not saying that positive action can't occur below 50, right? And again, this is the asterisk.
Mhm.
Positive action still can occur, but it's not necessarily a historically good sign to have seen, some longer term damage done to the rest of the market. Speaking of strength outside of the domestic space, though, we have seen international equities kind of up over the 1 week roll, outperforming the S&P 500 quite handily. Gold, of course,
Gold
continues
just
to rise.
handing it to everybody
I mean,
right now.
it's up over, let's see, where's my performance table here? Up nearly 9%. It's up more today, right? So we could be, up near 9.5% over the course of the last week. In terms of the kind of week to week point, it's been a relative leader within the commodity space. Crude oil has struggled. So the spread between kind of the top and bottom performing assets within the commodity space is widening, right?
Which in a sense is good for us, if we're seeing a little bit. But I guess that's part of it is there's so many other cross-curring themes right now that it maybe gets washed away a little bit and everything else.
Right. And the other thing that's quite interesting, and we didn't really plan on talking about this as much, but the dollar is also a very interesting asset around current levels.
We violated support this week at 100.
It did, right? And so again, we'll throw the chart up here. We have historically said, and for about the last 2 years, we've had to say this, one that tends to trend historically, not so much over the course of the last 3 years. There's your butt again. But we've seen this kind of post 3 consecutive sell signals violate its trend line. But again, that's been a pretty wishy-washy trend line over the course of the last few years. But more importantly, to your point, move past a low within that kind of significant range established around 100 on its default chart here for the US dollar. So weak dollar means tailwind for international equities, commodities, other areas outside of the overall space, which are going to benefit from a weaker greenback. This is going to be a really interesting spot, and it might act as fuel to the fire to kind of continue that international excellence that we've seen in 2025 so
Mhm.
far.
Well, I'd say we've talked a lot about asset classes, but we've also seen some stuff happening with on the earnings front because we got earnings kind of picking up last week and we're getting them on into this week.
Because what
So,
else do we need, right?
right,
It's
what
not
else
like
do we
it's not
need
like
going on right now? It's one of the interesting things because right now, if this was I would say a normal podcast, if you will, we'd probably be talking mostly about earnings season,
right.
what's going on here and how things are transpiring. But that's it's the tail of the tape. That's what we're given for right now. But we did have some banks report earlier this week, and mostly positive out of the banks. I think it was sort of dependent on which one you were looking. There was sort of
Right.
a mix there. I know Bank of America at least had decent action there. But we've had some others report earnings and some others that we continue to monitor. Even like today, Netflix upcoming later. Um, and what was the big one this morning?
UNH. Yeah.
United Health
Yeah, they're down
taking
about
a large
20%
move.
at the time of this recording here, and they've been a relative leader within the within the healthcare space in general. Actually, now I just checked it up, down about 23%. So they're also going to violate their trend line on its default chart here. Going back to the banks, I am very interested to see how regional banks hold up. We've got looking at KRE just as a representative. KRE is a regional banking representative, down about 15-16% so far this year, meeting a significant level of resistance from 2025 at 51. That's also the top of a pretty significant range in 2023 and 2024. So regional banks, I know the big banks have just reported, right? But watching these guys maybe more as a barometer for the overall economy, the health of,
Small business
small,
side
yeah,
almost.
exactly, right. And so, that's what you can think of. Again, these guys are going to be mixed in and out of bigger bank earnings and everything like that. But this is definitely of interest to me, especially with quite a maybe perilous technical picture that we've got looking here with that trend break, consecutive sell signals, and failure to post a buy signal in 2025. That is.
Yeah, and I mean, like you said, some of the bigger ones have seen some positive action. I called out Bank of America earlier. I think its chart still holds fairly okay, but I
Right,
mean, even then, some of those they've fallen down to threes or maybe even twos.
right.
Whereas we began the year as five for fivers or four for fivers. So even then, that's been a sort of everyone's waited with bated breath to figure out what's going to be transpiring in their earnings calls.
Yeah, and one other thing I'll mention, you talked about Netflix. Now, Netflix is not part of the Magnificent Seven, but it is one of the relatively larger names in there. And we've
And
seen
it looks better than most massive.
exactly, that's exactly where I was going. You look at those other areas, none of the Magnificent Seven, maybe one of them, I'm not looking at all the charts, but maybe only one of them holds a technically actionable fund score, or excuse me,
Stuck
technical
around here,
attribute
yeah.
score. Netflix is a five for fiver. It's got a nice base of support to work off down below as it looks to, attack those all-time highs, just over 1,000 there from earlier this year. But I'm curious to see if we see any fundamental follow through from some of the technical weakness we've seen from the Magnificent Seven names. Do we see, these stocks failing to meet fundamental expectations, or maybe, cutting guidance or something along those lines? Because we have seen technical deterioration from them. But what does that mean from the fundamental side of things? How do they, intertwine or interact with each other as we're kind of moving through what could be quite a busy earnings season, I may add.
Yeah, and I mean, not that it's necessarily the barometer for it, but I think that just a slight barometer for that talking point is United Health this morning.
Right.
Just sort of looking at what's their pace. And I think the story was this morning they cut their annual profit forecast and
Right.
ultimately now shares are down 20% or 23%, I guess, as you saw a moment
Right.
ago. And we're keeping an eye on some of that long-term support. I think it's there at like 440, but to your point, in some fashion, today was a prime example of we saw the fundamental deteriorate, and then we also saw the technical deteriorate as well.
Right.
So, this is what could transpire if something were in the offing for some of these stocks.
Right. And if you do, just as a general, it's not going to be blanket advice here, but if you do find yourself in a United Health United Health situation where you've got a position down 23%. Now, on that, every situation is going to be different, but you're encroaching on a major level of support. You're not necessarily oversold here, but you would expect to see some type of normalization. So if you've got holdings, tread lightly with this type of stuff, but I wouldn't necessarily, sell the news on a day you're down 25%. It just doesn't make sense to do that here. So kind of let the markets digest, find a spot towards the downside. Like David mentioned, 440 looks to be a pretty significant level of support. If you violate that, then sure, trim it, cut it. But at least in the meantime, try to let markets and kind of that's a battle between supply and demand play out. You might be able to get a better price if you do need to trim it for one reason or the next.
Well, it's been another eventful week.
It has. You got any plans for Easter?
Oh, just mostly hanging out with family.
Nice.
My son's birthday is today, actually, so we've got some plans over the weekend
Nice.
to do a variety of things with him.
Cool.
So
That'd be fun.
turning 12, man.
They go by fast, right?
Yeah, he's almost wearing the same size shoes as me, he's as tall as me. You name it, it just makes me
Just
feel
wait until
old.
it'll be driving a car. Yeah. All right.
Anyways,
Well, appreciate y'all listening. And as always, give us a call, shoot us an email if you got any other questions or anything like that. And otherwise, keep an eye on the charts and have a good one.